Before we dive into today's topic, innovation and alternatives, let's go back and begin with your story. Where did you grow up? What were some of your more formative experiences? And what led to a career in finance?
Okay, well, first of all, thank you for having me today. It's good to see everyone. I think you know it was not easy getting in today, and I'm a little worried about getting out. And hopefully this stops echoing. But I'm Doug Ostrover. I'm the CEO of a company called Blue Owl. We are a firm that focuses on credit. I'm going to get dinged for $100 for saying GP stakes. I'm not supposed to use the jargon, but I can't help myself, where we take stakes in managers. Robert Smith, we own a piece of Vista. And then we have a triple net lease real estate business. We have about $130 billion of capital, trade on the New York Stock Exchange. We have about a $14-15 billion market cap. In terms of answering your question, I grew up in a little town in New Jersey called Franklin Township, lower middle class neighborhood. Just to give you my background, I don't know if many of you have ever heard something called the Levittown. Levittown is where there's 4 rows of 4 types of homes, and your family had really made it if you had a few extra trees on your yard. And I didn't know anyone on Wall Street. I went to the University of Pennsylvania and started interviewing, primarily because my father, who had nothing to do with Wall Street, was just fascinated by stocks. We were very close. And he said he really wanted me to try it. So I started interviewing, had no contacts. Truthfully, I had an okay GPA, an okay resume, and I am not exaggerating. There was a book, it was called The Securities Dealers of North America. And I went and I applied to every single firm in the Securities Dealers of North America, 200 firms. And everyone rejected me, except one. There were 2 firms, Brown Brothers Harriman and Kidder Peabody. I'm not exaggerating. I got somehow stuck in their system, and they kept sending me the same form rejection letter every week. Although your qualifications are excellent, we can't proceed with you at this time. And the truth is, how I got to Wall Street was I was down to one last firm, E.F. Hutton, the only firm who was willing to interview me. Some of you have probably heard of it. The younger folks in the room probably have never heard of E.F. Hutton. And just by luck, at the bottom of my resume, under interest, I wrote film. And the guy who was interviewing me said, "What's your favorite movie?" And I said, "The Godfather." And he went on to tell me he worked as an usher in a theater. And The Godfather had been in the theater for a year. And we played Godfather trivia, and that's how I got the job. True story.
That's great.
I am not kidding.
And so talk a little bit about formative experiences, just in terms of your start at E.F. Hutton, which I am old enough to have heard of, and part of what led you now to be sitting in the CEO chair at Blue Owl.
Well, what I tried to do was just be a sponge. And we'll get to this today. I was really fortunate because at an early age, I knew I wanted to be an entrepreneur. And when I was at E.F. Hutton, and I was at a firm after that called L.F. Rothschild, it was the heyday of buyouts. People were doing buyouts with Drexel, putting down virtually no money. And I started thinking, why can't I do that? Why can't I go scrounge some capital together and try to do a buyout? And the truth is, the companies I was looking at, I was very fortunate that I never got a deal closed. They were terrible companies. I was going to use almost 100% leverage. But from those experiences, I started spending a lot of time thinking about where is the world moving? And how did I want to be positioned in that ecosystem? And if I could just get that partially right, I thought I could do pretty well. So I'll give you an example. I was in banking, and the year was, I think it was like 97, 98. There was a crisis, and I started thinking, I'd like to get involved in, I think there's going to be a lot of distress. And so I moved to that. And I stayed on Wall Street, and I worked my way up. I ran DLJ's credit business and then Credit Suisse's credit business. And what happened was, in 2004, we had a massive year at Credit Suisse. We probably generated $2.5 billion of revenue. And again, I got paid very well, and I went in and resigned after I got my check. And everyone said to me, "You're crazy. Why would you give up this seat?" And I gave it up because I felt the balance of power was shifting. That Wall Street, while super important, I saw this migration to people who could accumulate large pools of capital. And I decided I was going to go and give that a try. And for those who don't know my background, I built a business up with 2 partners. I sold it to Blackstone. I ran that business for Blackstone for 8 years. And then I had a very similar experience. And I'm sure we'll get into this. But I was sitting there. I saw this really interesting opportunity in direct lending. And I went in and I resigned from Blackstone amicably. But again, everybody said, "You're crazy." And in 7 years, we've built this, I think, pretty remarkable business. So.
Fantastic. So just before we jump in, a couple of housekeeping things. We are going to leave some time at the end for Q&A. So if you have any questions for Doug, please just jot them down, and someone will be around with a microphone. And Doug also referred to the jargon jar, which I've been told that if either he or I use any acronyms or jargon, that we'll each be putting money into the jargon jar, and apparently Isaac is keeping track of it.
I've already conceded. I'm putting in like $10,000.
That's right. He's just writing a check. So the Blue Owl website has a video clip that begins with you saying, "The world is littered with companies that came from nothing, fought their way to the top, and they get there and they stop innovating. They become somewhat implaceable. Complacency is something I am maniacally focused on." That's a great perspective for today's session. So let's start with what was behind your decision to leave Blackstone in 2015 to strike out on your own to start up Owl Rock.
Okay, and I definitely will come back to that quote because that is something I am maniacally focused on, complacency. But as I was saying, I was sitting at Blackstone. I actually left Blackstone in the summer of 2015. And in 2014, I saw really interesting, several trends occurring. One was, what I was focused on is called direct lending. The best way to think about direct lending is think about a firm like mine. We go out and we aggregate a pool of capital, and then we use that capital to act like a bank. But we don't have the same regulations as a bank. We're not taking depositors' capital. And we go and make loans, and we charge a premium on those loans. So if any of you have money at Fidelity or PIMCO or BlackRock in fixed income, that's effectively what we're doing. We can talk about why I think what we do is different, safer, but we get materially higher yields. So I was sitting at Blackstone, amazing firm. I was pleased to be there. But I saw a couple trends occurring. One, I saw more and more private equity firms were saying, you know what? I don't need to use Morgan Stanley, Goldman Sachs for all of my financings. Maybe I'll start using direct lenders. And then I also saw a bunch of the largest institutions in the world starting to say, you know, maybe this is going to be a big asset class and we should start allocating more capital. And I guess the third thing I just wanted to mention is the competitive landscape. If you're going to go out and take a risk with your career and do anything, you have to evaluate what the competition looks like. And if I were to draw a picture for you of the competitive landscape in what we refer to as this direct lending market, it's a little like a pyramid. And if you draw that pyramid at the bottom, the widest part, there were a lot of firms out there that could make relatively small loans, 10 to 20 million. Then you work your way up to 40, 60, 80. When you get to the top, 100, 200, 300, 500 million, lending to the biggest and best companies. For 20 years, it had been the same 5 or 6 companies that had dominated the lending landscape. And so I thought with a little bit of luck and a little bit of backing from investors, maybe we could go out and create a firm that could get to the top of that pyramid. And that's basically what we've built today. And we've been very fortunate. Timing was good. But that was the goal and that was the reason. And I think we've executed on that.
And it's a great example of innovation. You know, the disintermediation of an area of lending that had been dominated by the banks and capital markets for so many years. So
yeah, that's right.
So when you're looking at some of your peers in the direct lending space, what did you do differently by design when you were setting up Owl Rock?
You know, I get that question a lot because in about 8 years, we have become one of the top 3 players. I think our track record is as good, if not better, than anybody else in the market. What we really did was we came at it and we said, we're the new entrant. We need to be hungrier. We need to be more responsive. I'll just give you a great example. I'm very close with one private equity firm. They had done 10 deals with a direct lender. They said they'd never met the principals. When they called, people weren't responsive. And yet they needed their capital, so they kept doing deals. And that was a story I heard over and over. Not that these other firms weren't doing a good job, but it comes back to that complacency comment. You know, when you're the same 5 firms dominate a market for 20 plus years, it's just human nature to take your foot off the gas a little bit. And I can tell you their foot is back on the gas because there was a new entrant that came in and shook things up. And we've been able to, I think, take a lot of market share. And in addition, the market has grown a lot. We were right about where things were moving. And so we've benefited. And I think don't get me wrong, they're doing well also.
Well, you just showed them that there's a passing lane.
Yeah, exactly.
And so what's the backstory to the merger between Owl Rock and Dial Capital to form Blue Owl in 2020 and the subsequent addition of Oak Tree?
Okay, so that gets back to that quote you gave at the beginning that's on our website. You know, when I talk to my firm about where we are, right, in 8 years, started at 0, we have a lot of capital, we have all of our net worth in the business. Well over $1 billion of our own money in the funds. But I say, listen, there've got to be 10, 20, 30 other firms out there seeing what we've built and saying, how do we do it? How do we recreate what Doug and his team have built? And so the other thing I point out, I put this slide up every year. If you were to go back and look at the top companies on the New York Stock Exchange in the 70s, early 80s, top 50, and then you were to look today, with the exception of JP Morgan, and a couple oil companies that merged, there's nobody else. Right. Companies like GE were there, their market cap is lower. Companies like Kodak are bankrupt. Really surprising. And it's my belief that what a lot of companies do is they climb the mountain, they get to the top, and then they breathe a sigh of relief, they made it, they stop innovating, they stop spending. And what I really try to impress upon everyone who works for us is we can't become one of those companies. Yeah. So if you think about us being a direct lender, and I think my partner Sean is going to be speaking later, we have a business that takes stakes in private equity firms. We own stakes in 60 different firms. I was just talking to Robert Smith, one of our GP stakes. Jargon, John, I did it. Yeah. So the idea was that business will grow to have 100 stakes over time. Think about from being a lender. If one of those firms is doing something that has real alpha to it, that we can make an outsized return, I want to be able to call that firm and say, we need to be included in that deal. And what I'd really like is to be able to get a last look, not asking to do things better than the market. We just want to be able to participate. Well, think about 100 firms. If our average deal size is $300 to $400 million of a loan, that's 30 to 40 billion of incremental deal flow. And what's really interesting, we're the largest player in taking stakes in private equity firms. The second one is Blackstone. The third biggest player is Goldman Sachs. Their lending business and their stakes business are in completely different divisions. They've never tried to reap those synergies. And that's what we've tried to do. That's how we've innovated. People ask me, why did you start buy this real estate business where we go and we take a stake, we buy real estate, it's all sale leasebacks with investment grade companies. And then think of Amazon. Amazon, we just bought a distribution center. They leased it back from us 20 years and we own it. We get a great stream of income on that. We're not going to lend to Amazon. But when we looked at the market, we're talking to these private equity firms. Their companies own tens of billions of dollars collectively of real estate, and no one is trying to work with them on being an asset-light firm. Right. So it's just a way of providing another solution. So think of us being a solutions provider to this private markets ecosystem and trying to be an invaluable partner to these firms. And if we can do that, we're going to see the bulk of their deal flow. And hopefully by seeing the largest amount of deal flow, be able to create really good returns for our investors.
So I want to ask you one more follow-up question there. And just for full disclosure, Prime Quadrant has always been, held Dial and Blue Owl in high regard. And many of our clients, including myself, are investors in Dial and really appreciate the work that you and your team are doing. But in terms of innovation, how did it come about that companies were willing to sell a stake, willing to sell part of the equity in their companies?
Well, listen, our GP Solutions business has been at it for a long time. There are a lot of firms out there that are founder-led, and they need capital. Mm-hmm. Maybe they want to make an acquisition. Maybe someone's stepping down. They want to buy that partner out. Maybe they just need working capital. And a lot of them don't want the headache of being public. And we were just talking about this. I'm flying out tonight, hopefully, and I have my earnings call tomorrow morning. And, I think maybe I underestimated the headaches of doing earnings every quarter. There are a lot of CEOs, a lot of heads of these firms who are saying, we're never going public, but they need capital. And until our firm came along, they had no real way of accessing that capital. The other thing is they could go borrow money, but that comes with covenants and interest. And oftentimes they would just rather say, if we could find someone who can be a passive partner, let us run the business, pay us a full price, but share in our growth. That's what we did in the Dial business. And for those of you who've been in the funds, we've been able to put up just tremendous returns for a long period of time. And we just wrapped up our newest fund, which you're in a big way. And I'm cautiously optimistic we'll be able to do it again.
We support your sentiment, and thank you. So would you just take another minute and describe the firm, what Blue Owl does in the context of private capital markets, what makes Blue Owl model unique, and some specific examples, because it's the topic today, of innovation?
Yeah, so again, think of us as being the solutions provider, several legs to the stool of what we do. Our biggest vertical is being this alternative lender. To give you the scale, we have about 70 billion of loans. We have this business, the second leg, second biggest, where we take stakes in private equity firms, VC firms, real estate firms. And the third one is what we call our triple net lease real estate business. In terms of innovation, we're constantly trying to think about how do we create products that are in our core verticals where we can create, let's say, an outsized return, but take as little risk as possible. I want you to know the core value of what we do is, I joke around with our biggest investors, we call our funds stay rich funds. They're not VC funds, they're not even private equity funds. We're in the business of getting our investors a steady stream of income, but mitigating the downside. Now, I didn't listen, but I saw Robert Smith on the video. If I took you back 5 or 6 years, I'll give you 2 innovations we did. One is software. 6 years ago, there were about 20 firms that dominated the software landscape, buying software businesses. And we dealt with all of them. But in our seat, we work with 700 private equity firms. We noticed that virtually every firm we were talking to was starting to think about, should they invest in software?
Right.
And then we went out and we said, well, who's going to meet that demand? Where are the pools of capital? There must be some lenders out there making big loans to the software space. And I am not exaggerating. There were no large pools of capital. So we went out, we raised a $7 billion pool of capital. We've just raised another $7 billion. We've probably done about $20 billion of loans to that space. And we are the single largest lender to that space. 20 billion of loans, never a loss, nothing in arrears. You've heard about, I'm sure, if any of you were in that session, the benefits of doing that, of investing in that sector. So just from sitting around and sitting in our perch and observing what's happened and saying, where is the private equity market moving? And we saw them moving in a big direction towards software. If people are to ask me, what's the next big thing I see occurring out there? Really big market where there aren't large pools of capital, healthcare. It's big, growing. Think about if you're a biotech, life science, royalty, pharma, there's no capital today. So that's another area we're currently evaluating, haven't decided if we're going to do anything. But if we do, like in software, we have 30 dedicated software experts. We get a cyber deal, we have a cyber team, and we would throw the same resources at it. The second thing I would just tell you, coming from Blackstone, and I'll be quick on this one, is what's happened in bringing alternatives to the high net worth space. I don't even know if you're aware of this, but when I launched the new firm back in 2015, my number one thesis was we can deliver alternatives to the high net worth market better than what everybody else is doing. And that's a bold statement. So why did we believe that? When I went out and I studied the market, there were firms out there. The REIT market's been around a long time. There were a lot of people bringing products. But when you really studied the market, what I saw was there was high net worth product, and then there was institutional product. And what a lot of firms were doing was a deal would come in and they'd decide, does it go to the institutional side or does it go to the high net worth side? Now, you peel the onion back a little bit further, and what I really noticed was the returns in the institutional side were materially higher than in the high net worth side. So clearly the inferior product was going to the high net worth investor. So what we said was, regardless of what the wrapper is, whether it's a high net worth institutional, we designed our funds from day one. A deal comes in, there will be no cherry picking. Every single loan, dial deal, real estate deal that comes in is shared equally and ratably by those strategies. So let's give the high net worth investor the identical experience. Same fees, coming in at the same price, and most importantly, get the identical product.
Yeah.
And that today doesn't seem so revolutionary, but back then, 8 years ago, It was, and believe me, there are still plenty of firms that are still cherry picking between assets, because if you didn't set your firm up that way, the institutional investors, they believe all that product should go to them.
Absolutely.
We set our funds up from day one that there's equal and ratably sharing. So those are just two
Set the
things we've
stage.
done.
So we've talked a little bit about software, and that you mentioned that you have a stake in Vista and Silver Lake, and Owl Rock has also financed many of the portfolio companies managed by both firms and other large private equity firms who specialize in tech. What do you find so attractive about the space?
Well,
Hasn't been, performance this year has been a little bit difficult for investors, but
that's
the short term.
that's really interesting. So first, and I don't know if any of you were, I didn't listen to Robert Smith speak, but I've heard him talk in the past. So what did we love about software? Well, one, we don't focus on startups. We focus on very large software, enterprise software companies. Think of those products as being mission critical, really running a business. Think of a utility that delivers electricity to your office. You go into a recession, downturn, you don't turn the power off. Well, the companies we're financing, these are big and, as I mentioned, mission critical products. You're not going to go back and rip out the software and go to paper. So what we look for are these companies that have high recurring revenue, very little churn. We are not factoring in growth. And we're looking at the existing users and saying, does that more than cover our debt? What we do is we finance buyouts. So think about Vista, big buyout firm in software. They come and put equity in, and we provide the debt. An average deal today is 70% equity, 30% debt. They are focused on growth. To make the numbers work for them, they need the business to keep growing like this. As a lender at 30%, we don't. And this you're going to find really interesting, how quickly the world can change. I was making those types of loans a year ago, not even a year ago, January, 7-8 months ago. And the way those loans priced was LIBOR. They're all floating rate. Everything floats. Every 30 days it resets. LIBOR was at basically zero, so we got a floor of 75 basis points plus a spread. That's what we get paid. LIBOR plus 550, so that was 6.25%. Today, that identical loan, LIBOR has moved from basically 0 to 4%,
right,
and our spreads have moved out to 750 basis points. So that same loan, and I would tell you the loan today is even more conservative, has gone from yielding 6 and change to yielding 12. And so what I say to a lot of our investors is, if I can compound your capital at 12%, that's with no leverage, and we use some strategies with leverage to drive it into the teens, and you're the top 30%, why buy the equity? Why take the risk of what the growth is?
Yeah.
And by the way, I don't know how long it will last, but that is what's going on today. And it changed very, very quickly.
Yeah.
And so just going back to answer your question, software basically has the attributes of investing in almost like an annuity. Now, again, the private equity firm wants an annuity with growth. We just want stability. Mm-hmm. If we have that stability, we will get our money back. And as I mentioned, over the last 8 years, we've invested in about 20 billion of those loans, and we've never had a loss or nothing in arrears.
Right, right. So in your seat as a provider of capital to both private equity firms and their portfolio companies, you have arguably one of the best perspectives into trends in the private capital markets. In addition to healthcare, what trends stand out to you today, and where do you expect to see further innovation?
And I'm not sure if anyone covered some of these today, but I'll hit on a few. One, because of the volatility in the markets, I think the private equity community has resigned themselves to the fact they're going to hold on to assets longer. And many of the firms we talk to are now thinking they like that. And if they're going to hold it longer, they have pressure to get money back to their investors. What are they going to do? One of the things they're looking at, if they held it a long time and they've paid down debt, maybe they do a recap, meaning they put some leverage on it and pay a dividend that would go to hopefully all of you in this room. Another one that I think you and I talked on the phone earlier is they're taking assets. If you were to look, what most private equity firms do, they don't take their companies public. Most of the time, they're selling to another private equity firm.
Right.
I am not kidding. I've been doing this a long time. There are companies that I financed when I just turned 60, companies that I financed when I was in my 30s. And they have sold 6, 7, 8 times. And each time I'm financing them again and financing them again and again. So I think one of the biggest changes is that a lot of the firms are saying today, you know what? Why am I selling one of my best assets to a competitor? What I'd like to do is figure out a way for me to own it. And remember, private equity firm, you get to the end of the life of the fund, you got to give the capital back. Mm-hmm. And I'm sure we'll get into this, but they're working on ways to say, oh, let me move that asset and hold it for another 7 or 10 years.
Right.
And that's probably, as I look out there, holding companies longer is probably the biggest trend I see in the market.
So just to switch topics for a minute, SPACs, which are special purpose acquisition corporations, have been around for decades, but there was a resurgence that reached a fever pitch in 2020 with new entrants that included sports celebrities, musicians, and even a former US president. Recently, Owl Rock and Dial used SPAC technology in the formation of Blue Owl. Why did you use a SPAC rather than traditional capital market financing? And what are your thoughts on the SPAC market today?
Well, hopefully none of this will show up in the press, but I hate the SPAC market. And I think a lesson for all of us is when you see a market exploding like that, where so many people have no real reason to be buying a company, not picking on basketball players or former presidents or whoever it may be, the reason they were all doing it is the economics were so skewed in favor of the group creating the SPAC, these special purpose acquisition corporations. And that's not a ding, by the way. So the way it works is you put up a very small amount of money. You go raise a large pool of capital. Let's say it's a $500 million, I'm going to call it a SPAC, but we've defined what SPAC is. You go and raise a $500 million SPAC. You've put up maybe $20 million. You get if you get a deal done, any deal, regardless of how it trades, you get 20% of that SPAC. So you get $100 million just for getting a deal done. And if the deal trades poorly, you still get paid. Now, as an owner of a SPAC share, you have a right to vote on the deal. You can say, I'll participate, or you can opt out and you get your money back and you get a zero return. And so there was a while where having that free option had some value as an owner of a SPAC share. And this may be way too much detail, but the bottom line is this. All the economics were with the group setting up the SPAC. And so everybody who bought companies, not everyone, but most, lost an absolute fortune. Mm-hmm. So the question is, if I really dislike SPACs, why did I do one? And I will tell you, I regret doing it because if I go on TV, which I do because we release our earnings and I get interviewed on TV often, they always say, oh, this is one of the successful SPACs, which happens to drive me crazy. The reason we did it is this. We merged with this company called Dial, which is the GP stakes business. To do a traditional IPO, you have to merge the business ahead of the IPO, consolidate your financials. I refer to it as like scrambling the egg. And then you file publicly and you go and do an IPO. The problem is, what if the markets are like today and you can't get your deal done? Mm-hmm. Now you've scrambled the egg. Yeah. The owner, the former owner of Dial said, which is Neuberger Berman, said, we don't like the scrambling because you control it. Now we own a smaller stake and we don't control that asset anymore. They pushed us to do the SPAC because the SPAC, you're basically merging into a shell company. If you don't get it done, it's easy to unscramble the egg. So that is why we did it. But I'm going to tell you just a tiny bit of inside baseball. We merged into a $250 million SPAC. For all intents and purposes, every holder of the SPAC turned the deal down. Now, we had raised a lot of money from people who had invested with us for a long time. But because we merged into the SPAC, I still had to pay them their 20%. I had to pay them $50 million in Blue Owl shares.
If you can get it.
And we got no proceeds from the SPAC. It was crazy. So I could go on for the entire 45 minutes on this, but my advice is it's a product that everybody in this room should just stay away from.
Okay, we'll leave it at that then.
Yes.
So another area where we'd really love to hear your views is, while the IPO, which is initial public offering, and M&A, mergers and acquisition activity, is down dramatically this year, GP-led secondaries, and GP being general partners, how am I doing, Isaac? Led secondaries appear to be increasingly popular and entering mainstream. Would you take a minute to just explain the strategy of GP secondaries and share your view on where they make sense and where they don't?
Yeah, so this is what when you asked about trends in private equity and credit, this is probably the number one trend I see going on in the private equity market. You'll hear it's GP-led secondaries, continuation funds. So let me just describe how it works. Private equity firm owns an asset. They've owned it for 7 to 10 years. They like it a lot. They have a very large gain in it. They have a choice. They can turn around and sell it, or there's a new market developing where they effectively sell it to themselves. They take, let's call it asset A, they move it into a new box, and they go to all the existing investors in that fund. And they say, investors, you have a choice. You can move your interest and keep owning this, which we think you should do, or we will raise new money at this price and you can get cashed out. Today, about 60% of the investors opt out, 40% roll. What I find really interesting about the space is, one, these are assets that someone has owned for a long period of time. They like it. They have a very large gain in it, so they might generate profit for the partners, 50, 100. I've seen much bigger numbers than that. And the deals we've played in, we require them to roll 100% of those profits into the new vehicle. So we want to know that they're truly committed. Yeah. So I think this, for everyone in this room, this is just a trend you should watch, because I think it's going to be a better way to invest in private equity. If you can find a manager who's going to go around, and we're thinking about this as being a solutions provider, we want to be able to go to the private equity firm and say, we like that asset, we'll help you back it. Mm-hmm. Because you're partnering with PE on their best assets. They're putting in usually, if it's a $5 billion fund, maybe they're putting in 100, 200 million. They're often putting 100, 200 million in this deal. So there's incredible alignment. And I equate it to you go buy a new asset. You never truly know what you're getting, but if you've owned it for 7 or 10 years, there's no surprises. So I like this space. I like where it's going. The only negative is this. The pitfall is there, and we're seeing this, there will be some firms where they own an asset, they've owned it for 7 or 10 years, not because it's their best asset, but because it hasn't fully lived up to expectations.
Right.
And they keep hoping it will get better. And so they'll take that asset and say, oh, we love it, we're gonna move that into a GP-led secondary or a continuation fund. And that is the pitfall. And so like anything, there will be some excess. But I think if you execute it well, and I'm sure you and your partners will find great people to help navigate that part of the market, I think this will be a space where you can protect the downside better and really cherry pick the premier assets from the premier managers. Think about being able to go out and instead of give all your money to one manager or two, have someone who can go out and say, all right, here are the 25 managers we're gonna work with. And we're gonna try to buy from each of them their 1 or 2 best assets that they want to extend the life on. I think that will be really compelling and a place, if you were to ask me, I think that part of the market we are gonna see explode over time.
Fantastic. So another segment on the rise is the introduction of Evergreen funds for private equity and private credit strategies as an alternative to a closed-end fund. On the one hand, it makes perfect sense, as you're saying, for a manager to favor a continuous offering structure as an alternative to multiple closed-end structures. But the flip side is the possibility of there being a mismatch between assets and liabilities. In other words, illiquid investments, so private equity and private credit are inherently illiquid, in the form of an evergreen fund where the investors expect there to be liquidity. Since Blue Owl uses both vehicles, closed-end and evergreen, we'd be interested in hearing your thoughts.
Yeah, listen, it's a complicated question. The negative to a lot of private strategies, and I think you really have to differentiate between private credit and private equity. Private equity being you make an investment, you get nothing back for a long period of time. And private credit, where you invest and you start earning a coupon immediately. And loans get paid back. Sure. So money is coming in and out, whereas in private equity, it's harder. Yep. You could sit there, market like this, there'd be nothing coming back. I like the structure for private credit. I think it's important if you can manage that liquidity mismatch to provide some liquidity. I think for most investors, they don't take advantage of it. Mm-hmm. So I can tell you, we have a sizable pool of capital. We're reporting tomorrow, so I can't give the exact numbers, but it's de minimis in a very difficult environment because we're throwing off very nice returns. Mm-hmm. So what is the pitfall? The pitfall is, and what we're describing is you're in a fund that owns a private asset. How do you provide liquidity if you have quarterly liquidity? And so what you need to do is maybe have a few public assets, but most likely you're sitting on leverage you're not using, or you have some levers to pull to meet redemptions. What it means versus the closed-end fund versus being able to take capital out is your returns are going to be a little bit lower because we have to provide capital for liquidity. We have to have that reserve. Whereas in the pure private fund that has a finite life, we can be fully invested because we don't have to worry about redemptions. Right. So you need to go in knowing there's going to be a little bit lower return in return for getting that quarterly liquidity. And I think depending on who the investor is, either one, I think they'll figure it out. What's interesting is when we launched the product with the quarterly liquidity, we geared it towards the high net worth space. We knew the returns would be a little bit lower because we not using as much leverage, we're carrying more cash. And I thought we wouldn't get a lot of interest from the institutional market. What's so interesting is moderate-sized institutions now are saying, this is a good place to put our money. And if the world turns and we need to get our money out at some point, a year, 2 years, 3 years, we like having the liquidity option.
Right.
So lots of endowments, foundations are coming into the strategy because they really value that ability to get some liquidity. So it really depends on your investment horizon and how badly you think at some point you might need the capital.
Yeah, and I think it's just important for investors to go in eyes wide open, because you look at an evergreen fund where you have an expectation of liquidity, and it's only when the markets implode that managers have to put up a gate or restrict liquidity. And so you're seeing some innovation there where, managers are creating side pockets for clients who want liquidity, and they can take their proportionate share of the fund, put it into a side pocket, and you get liquidity as the underlying investments are liquidated. But it doesn't have the same liquidity as the public markets, where if I want out, maybe it's a reduced price, but I can get out, and I can get out now. So I think it's just a matter of eyes wide open. And again, we look at the innovation and changes that are happening there. So another question that I'm assuming is on everybody's mind is, from your vantage point, do you see any pockets of systematic risk in the financial system today?
Well, it's something I spend a lot of time thinking about. And I would tell you first of all, when I look back at 2008, I always ask myself, what did I get wrong? And what I think all of us understood, we've all read about, or that movie, The Big Short, and what was going on with mortgages and how easy it was to get leverage. But what I didn't understand was just how pervasive leverage was in every aspect of the capital markets, everywhere. And I'll just give you a quick example. If JP Morgan was making a loan, $5 billion loan for a big buyout shop, they used to go raise $5 billion. Then they quickly realized, you know what, we'll use some derivatives and we'll go out and we'll say to everyone, you only have to put up 10%. We'll lend you the other $4.5 billion. You put up $500 million, we'll lend you $4.5 billion. But you have to keep putting up margin if that loan gets quoted down. Think about this for JP Morgan. The old model was $5 billion loan, you make 2 points, you make $100 million. That, when I was running leverage finance, I was pretty happy with that. But they figured out we can make the 100, and now we have this $4.5 billion loan outstanding, and we're basically going to make another $100 million every year that loan is outstanding. I didn't realize in 2008 there were tens of billions, hundreds of billions of these derivatives in the market. And so when the world started melting, the prices they'd move so quickly down because margin would keep coming in, and JP Morgan, Goldman Sachs, Morgan Stanley would keep selling. I have gone out and I have really probed at the banks, trying to understand how much leverage is in the system. And there was a really big red flag for me. And it turned out not to be such a big deal. But if you ever want to read an interesting story, Google tonight Bill Wong, something called Archegos. And this was a guy who got convicted of insider trading, managed to raise money, and he went out and started borrowing massive sums of money from Goldman and Morgan and Deutsche and Credit Suisse. And with each of them, he bought the same 5 stocks. And on paper, at one point, he had, I don't know the size of the gain, but it was well over $10, $20 billion. But then these stocks started going down, and he had to post margin. And one day, these 4 or 5 Wall Street firms woke up and said, oh my God, how did we lend this guy? Right. I'm not exaggerating, $40 or $50 billion, and it was all in the same stocks. And when I heard this story, I thought, wow, we are on the verge of a repeat of 2008. It's going to happen again. But I went out and I've really probed at the banks, and they're not going to tell me everything, but I'm not seeing it now. It's not as pervasive as I thought. I know we're running out of time, but I want to tell you just a very interesting part of that story. So you had 5 firms. They all had the same exposure to this Archegos character, same stocks. So I think Credit Suisse said, we need to have a meeting. We can't all start selling out the position because we'll drive the price really low. If you Google this, you'll see Credit Suisse lost like $5 billion on this. Goldman Sachs lost nothing. The story, I don't know if it's true, I don't want to get in trouble, but the story is they had a meeting, they all got together and said, we're going to partner and we're going to sell down together. And the story is the Goldman representative, by the time he walked out of the room, was completely out of his exposure. I think it's a true story. And if you look at the losses, it probably is true. So I would tell you what I was most concerned about was leverage. Think about this for a minute. I saw this stat. In the United States, between the decline in stocks and the decline in debt, there have been $30 trillion of losses. It's interesting to me that we haven't heard of people using lots of leverage like we did in 2008. The losses are greater than 2008.
Right.
But we're not hearing of people being max leveraged up and getting carried out. And I thought we would have heard of that. So I don't know if it's out there. That's what concerns me the most. If there's a lot of leverage, the big leverage unwind, that is what creates systemic risk. I will tell you, I had concerns, and I know we need to wrap up. When Credit Suisse was being talked about as potentially defaulting, what would be the ripple effects there? Because the balance sheets of these banks, it's hard to even comprehend what they touch, not just in the cash markets, but in the derivative market, which is a very large marketplace. So I had some concerns about that as well.
Very large leveraged marketplace.
Yeah.
So before we wrap up, assuming you make the investment decisions for your family, how do you invest for yourself and your family, personally?
So I am a very conservative investor, and the bulk of my capital is in our funds. I mentioned our funds are stay-rich funds. They compound at a nice rate of return, and that's where I invest. Now, I do want to share with you, though, that after all this time being conservative, and I mentioned we're the largest lender to the software space. I talked to everybody in the software market, and the growth firms, they were making staggering amounts of money in the last 5-6 years. So I broke down 2 years ago, and I invested a lot of money, well, a reasonable amount of money into these growth equity firms. And I have to admit, the first year, I thought, wow, this is incredible. I'm not even doing anything, and look at these returns. And the second year, I thought the exact same thing. This year, I'm thinking to myself, you had a moment of weakness. What is wrong with you? Like, you knew better. And so listen, for a long period of time, I have just taken a very conservative approach of let me take my capital and compound it in a very nice, safe way that REITs in the United States, I'm not sure here, there's some real tax advantages, so I've done that in conservative REITs. And that's the way, for the most part, I've invested for a long period.
Nothing wrong with slow and steady wins a race. So final question before we take a couple of questions from our audience is, if there was one piece of advice that you would give to family offices and ultra high net worth investors, what would that be?
Well, you just said slow and steady, so I would say it a different way. Capital preservation is paramount.
Yes.
At the end of the day, all of you in this room, myself, you work so hard and you need a lot of things to go right in your life to accumulate wealth. It's very easy to lose it. The other thing I would say that I've learned is try to figure out what the rate of return you really need. Not the rate of return you want, but what is it you really need? We all want 20+%, but I am telling you, to make a 20+%, you need to take a lot of risk.
Mm-hmm.
And by the way, when rates were near zero, and a lot of us were striving to make a 20, that you had to take an enormous amount of risk. Given where rates are today, I think all of us in the room can make an adequate rate of return by taking a lot less risk. And that's what we advocate, and that's what we've tried to do as a firm. And hopefully I have a chance to come back and speak again. And if we invest in other products, you'll see everything we do is let's have a nice, stable, steady state rate of return, a little bit of upside, protect the downside. And I think that's really how we've been investing and how I personally invest.
Anytime I talk to somebody and they say they want to make a 20% rate of return with no risk, my response is, and I want to be 2 inches taller. What's your point?
Yeah.
On that note, we'll open things up. We have a couple of minutes left. Any questions from our audience? Peter, you must have a question. We have a microphone that... And so now people can hear your question. We're going to ask you to repeat it.
In terms of your advice to families looking to build a slow and steady portfolio that would protect the downside and preserve capital aside from investing in blue owl strategies, what would your advice be?
Yeah, so look, I think there are two parts to it. It's having a sleeve where if you want to take risk is fine. I just started a family office with my partner, Mark Lipschultz. We're evaluating this now. We are looking for two things. We're looking for a stable rate of return where we can compound our money over a long period of time. And then we have a portion that we're also trying to be highly tax efficient. The tax rate for us is very high. I mentioned real estate. We'll just take our REIT, our triple net lease fund. It's throwing off, let's just say, an 8% today. We pay maybe 60, 70 basis points. So we're earning a 7 after tax on that,
right,
with investment grade counterparties. That to us is a pretty good place to be. And so it's evaluating things like that. I'm not saying you should take no risk. Life would get kind of boring if we went through life taking no risk. But I think it's really evaluating where you are in your life and what it is, what is your income needs and how much realistically can you lose? Mm-hmm. And I can tell you, we're thinking, we don't want to lose a lot. We're thinking we've made a reasonable amount of money. And if we just compound it in a conservative way, in a tax efficient way, we could do pretty well. And we're working for our children and charities at this point. And so that's the way we're approaching it. And I think it makes sense. And by the way, I'm happy, hopefully, if I do get the invite back, we are on a tour right now, meeting with CIOs of I can't say every, but many of the major family offices, trying to figure out what are they doing versus what we're doing. And I will tell you this, there are some that are very focused on taking it and getting it to a whole new level of wealth, taking a lot more risk. That's not our aspirations. We're trying to do something different.
One more question before we break for cocktails. Yes, sir. The microphone is coming to you now.
Hi. Hello. You mentioned that REITs is a fairly safe bet. What happens if in a year's time there is a major real estate hit how would you feel, or how safe do you really feel REITs would be in 1 or 2 years' time based on the interest rates going up and the uncertainty?
Yeah, and I apologize if I wasn't clear. When I was referring to REITs, over time I've been in and out. I was really referring today to what we're working on, and a REIT, really the triple net lease market. I view that as really having like belts and suspenders. We are going and buying an asset from an investment grade counterparty, and they agree to pay us a rate for a long period of time, 15 to 20 years. So if I have Amazon credit risk, that asset might go up or down in the short term. I'm making a bet over the long term it goes up. But I have Amazon paying me that rate of return for 20 years. 15 years that we've been doing it, we've never had a tenant not pay because they're all investment grade. And we've been able to ride the cycles of rent. And there are times where we can't turn around and sell something at a profit, and we just make a coupon. And there are times where rates have come down and we've been able to unload assets at much tighter spreads than where we bought them. So that's, again, something very conservative. There are some people are advocating, hey, we're going to buy student housing, we're going to buy this, and I like those assets. But what I was referring to something was very specific, where we not only own the real estate, but we have an investment grade tenant paying us a coupon. By the way these deals are structured, for those who aren't familiar with a triple net lease, is all the cost of the asset is borne by the tenant. We just get an income stream. There's a leak in the roof, Amazon's fixing that. If their taxes go up, they're paying for that. We just get the lease stream.
Great. Well, on that note, and I know that we could continue on for another hour, we want to thank you. I mean, it's been our sincere pleasure to host you today. Thank you so much for joining us in Toronto. We hope you don't have any problems getting back.
Well, we'll see, but thank you, everyone. I really appreciate it.
And Isaac, yep. And I think we have something.
What do I owe, Isaac?
Well, we have to tally up. No, we don't care about the jargon jar right now. We just have a token of our appreciation for you.
Oh, great.
I think we do, somewhere.
Oh,
And a
okay.
thank you. There we go. We do. Larry Torkin, one of my favorite people in the world. Can I just interrupt you for 1 minute so that we can give this to you?
Oh, wow.
There's our gift. And hopefully we're going to get a picture with you.
All right, great.
Great.
Let's do it.
Thank you.
Thank you
Thank
so
you.
much.
And there you are. So it's golf and football and the Hawks.
Oh, you guys really did your
There
work.
you are.
Wow.
You do your homework, we do ours.
Thank you very much.
Right.
That's